And you probably saw the headlines. Mortgage delinquencies rates are down. But here's what nobody tells you. The number doesn't mean what you think it means. Hi, I'm Marco Momeni, working with real Toronto families every single week for the past 24 years. The headline says delinquencies rates are falling. But the actual story in Ontario is a lot more complicated. So let's break it down clearly. National numbers look good. Toronto numbers, not really. Let's put real meaning behind these percentages. Canada's delinquency rates dropped to 0.22%. That means 22 out of every 10,000 mortgages are now behind their mortgage payments. For Ontario, it's rising to 0.23%. Toronto is even higher at 0.24%, meaning 24 out of every 10,000 mortgages are now behind. For British Columbia, the numbers climbed from 0.16% to 0.19%. Meanwhile, the more affordable provinces like Atlantic Canada, Quebec, or Prairies improved and pulled the national numbers down. Canada looks stable because the smaller provinces recovered, but the market with the largest mortgage sizes, like here in Toronto or Vancouver, they're under the most pressure. The national number fell while the high debt markets got worse. So why did the national delinquencies rate go down? Mostly because variable rate borrowers finally felt a bit of relief after 3 very tough years. That alone helped some households stay afloat. Places like Atlantic Canada, Quebec, and the Prairies saw stronger wage recovery and lower carrying costs. But for Toronto, when homes cost half or a third of a Toronto property, that difference shows up in the data. But the biggest factor, and the one almost nobody talks about, is the renewal wave that's still coming. More than 1.15 million mortgages renew in 2026, next year. And here's the important part. These are the people who locked in those ultra low fixed rates during 2020 and 2021. Rates like 1.4 and 1.6%, maybe 2.3%. Those days are long gone. Today, the lowest 5 years fix is around 3.6 to 3.7%, almost double what many locked in. And that's where the real payment shock begins. On a $1 million mortgage, going from 1.39 to 3.6% means your payment jumps by more than $1,100 every single month. You don't need the chart to know that hurts. And the reason delinquency rates look calm right now is simple. Most of these renewals haven't hit yet. Now let's talk about places like Toronto and Vancouver and why they feel this shift harder than the rest of the country. Could it simply be the mortgage sizes? When the typical mortgage is about $800 to $1 million, even a small rate jump hits like a brick. Payments don't rise by a little, they explode. Or maybe it's the debt to income problem. Canada's sitting around 180%, and Toronto is basically leading that pack. When households are stretched that thin, any increase in carrying costs become a shock. Or is it the condo investors? Maintenance fees are rising, rents are coming down, more vacancies, margins were already very thin, and now they're basically gone. Or honestly, is it all of the above? Because real world pressure doesn't happen from one thing. It comes when all these factors stack up on top of each other. And before anyone ever misses a mortgage payment, they change their behavior first. People cut spending, delay repairs, or quietly prepare to sell long before the bank sees a late payment. And there's something else going on that barely makes the headlines. When delinquency rates drop, banks actually get more comfortable. And when banks feel safe, they loosen up. They extend amortization. They approve refinances. They restructure payments. That flexibility alone keeps delinquency rates lower than they would normally be. And Canadians, we're very predictable in one way. We protect the mortgage at all costs. People cancel trips, skip renovations, or cut out on dining. Anything to keep that payment going through. But there's also a quieter group. I call them shadow stress group. They're still paying their mortgages, but only because they're draining savings, tapping credit cards, using their HELOC, or borrowing family money. They're not delinquent yet. They're not behind the mortgage yet. But they're right on the edge. So even when delinquency rates look better, the financial pressure underneath might actually be rising. So what all of this really mean in the GTA? For buyers, remember, some sellers want to get ahead of their renewal. That creates opportunities, but every pocket behaves differently. For sellers, remember, Toronto isn't one market. It's dozens of micro markets moving at different speed at different directions. A strategy matters more than the headlines. And for investors, watch rental income and vacancy risks very closely. This is a moment to upgrade your portfolio, not guess. Here's the truth. A lower delinquency rate sounds like relief, but in markets like Toronto, it's actually a warning to pay attention. The next 18 to 24 months will be shaped by mortgage renewals, not headlines. People who came out ahead will be the ones who, understanding the renewal timing, plan early, and make strategy-based decisions before pressure hits. If you have any questions about any of this, I'm just a phone call away. See you in the next video.